to introduce the President of the European Central Bank, Mario Draghi. From Rome, he got his undergraduate degree at the Sapienza in economics in 1970. And in 1977, his PhD at MIT with Nobel Prize winners Modigliani and Solow as his advisors. He then followed up in academic career in Italy from 1981 to 1991 as professor of economics and monetary policy in the University of Florence. We stayed in the World Bank as executive director, and then in 1991 to 2001 as Director General of the Italian Treasury. Direct experience in the financial markets in 2012-2005 in Goldman Sachs. And 2006 to 2011 as when he is the governor of the Bank of Italy. In 2011 is when he enters as president of the European Central Bank. An impressive CV, combining a very strong academic background, research as a professor, but also of civil service, of public service, both as a central banker, but as treasury director, knowing both sides of fiscal and monetary policy. An international one, and in particular, an European one. Still, that would have been possibly a story of a central banker of the European Central Bank. But here, years down the road, people will write the history of monetary history of Europe or central banks, and we'll have books, as we had from the last century, like the Milton Friedman and Schwartz classical book of the monetary history of the United States, or more popular recounts of the laws of finance. And they will talk of, they will talk of both of them. Ben Bernanke and Mario Draghi have been by far the most important ones. Not only because they had to face the crisis, the financial and the euro crisis, but also because they had done an authentic revolution on what central banking is all about. They found themselves not only a serious financial and debt crisis, but that classical instruments like interest rate policies and so on, the so-called conventional policies, could not do the job. It is when we start all the unconventional policies, and behind this, it was this fact. We had two major central bankers, or the two main important ones, with a very strong academic and research background to understand how you have to have the courage to act in a different way. Mistakes that were done in the crisis of the 20th century in the 30s were not done that time. But in particular, that was particularly more critical in the case of the ECB, because the first time that was facing a challenge. It was the major stress test for a new, relatively new central bank. Everyone knows and has been cited over and over his intervention in July 26, 2012. Whatever it takes. And yes, it has been a lot of research, and more research will be done about the impact it had in changing the path of the financial markets. This sentence has been here over and over as the one determining the change. And he will be famous by this. But no one gets famous in a real way to just say a sentence. You need more than that. You need to have policies, as at that moment they had developed both in the Federal Reserve Bank or the Bank of England, but then now in the ECB, the outright monetary transactions, AMT. But policies are not enough. Even if they are good policies, you need credibility. You need that when one stands and says something like this is credible. And you don't gain credibility out of the blue. You gain credibility because you have a strong institution behind, you have a professional record of being a proper independent central banker. And it's not an easy task. You have to measure your words. You have to know when you can speak and when you cannot speak. It's not an exercise of vanity. Thanks to him and this policy change. We just finished, or finishing, we had the final conference of Horizon 2020 project, or a demo, on assessing the fiscal and monetary policy of the Union, of the EMU. And those are the things that we have learned about understanding why a crisis has specific elements within a union, and how important it was to attack and to confront the debt crisis, but also how important it has been to have an institution like the ECB, and creating more like the ESM. Mario Draghi has been always in favor of developing more institutions and institutional strength for Europe. He has practiced that, and I think we should learn from him. Think for a second how this State of the Union on solidarity in Europe would have been if Europe had failed in 2012. Certainly, there will be very dramatic issues to discuss of solidarity. But the job of us as economists, when we do research, is to think about institutions and policies that will help us to avoid that situation. And when is in policy is to avoid that. Is this for today? He will address talking about risk reduction and risk sharing in the European Monetary Union. So please welcome with me the former Professore dell'Università di Firenze and now President of the European Central Bank, Mario Draghi.
Well, thank you very much, Professor Merriman. Your words are too kind, even moving, but thank you. Should also say that it's quite something to speak here. I think I came here last time in a school trip a few years ago, and I had no sense of how beautiful this place is. Dear President of the European University Institute, Professor Renaud Deus, dear ambassadors, dear Vice President of the Region, Ms. Monica Barney, dear members of Parliament, dear Lord Mayor, Mr. Dario Nardella, dear chairs and professors, and dear students. Ladies and gentlemen, it's a great pleasure for me to be invited by the European University Institute, which in many ways mirrors what the European project is for. It was founded to encourage exchange, cooperation, and a common European vision. Since then, the university has made countless contributions in the fields of economics, law, political science, and history. It has often been the meeting point where academic research helps answer the urgent policy questions of the European Union. A decade after the financial crisis, the euro area looks set to exit more resilient than it entered it. Much of the harm caused by the economic downturn has now been reversed by a consistent period of growth. And some of the institutional and structural factors that exacerbated the crisis have been addressed. But we know that our monetary union is not complete. The crisis revealed some specific fragilities in the euro area's construction that so far have not been resolved. To make our monetary union more robust against these future challenges, we need to address these fragilities. Let me say a few words on the evolution of the crisis, because then we may be able to draw some lessons from that. The crisis took place in 5 main phases. The first phase was similar across advanced economies. Most of them had a financial sector characterized by poor risk management, low capital and liquidity, inadequate corporate governance, and weak supervision and regulation, diluted by many years of excessive optimism in the self-repairing power of the markets. When the Lehman shock hit, banks exposed to toxic US assets ran into difficulties, and some were bailed out by their governments. In the euro area, these banks were mostly located in Germany, France, and the Netherlands. Bank bailouts took place on a staggering scale. In 2009, they totaled around 8% of GDP in Germany, 5% in France, and 12% in the Netherlands. These bailouts did not greatly affect sovereign borrowing costs, however, thanks largely to the relatively strong fiscal positions of the governments implementing them. In the second phase, the crisis spread to banks in Spain and Ireland that had similar weaknesses, but were instead overexposed to the collapsing domestic real estate market. Another wave of bank bailouts followed, and some signs of tensions in sovereign debt markets began to appear. These tensions were compounded by the third phase, which began when the Greek crisis shattered the impression that public debt was risk-free, triggering a rapid repricing of sovereign risk. To those who saw the crisis as a consequence of moral hazard, this represented a required return of market discipline vis-à-vis sovereigns, a view that was reflected in the Deauville Agreement in October 2010. These events spread contagion to all sovereigns now perceived as vulnerable by financial markets. But they affected most of all those with high public debt levels, a lack of fiscal space, fragile market access, and especially low growth. Sovereign risk was then transmitted into the domestic banking sector through 2 channels. The first was through direct banks' exposures to their own government's bonds. Between January 2010 and July 2012, banks in Greece, Italy, and Portugal incurred aggregate losses on sovereign bonds of vulnerable countries amounting respectively to 161% 22%, and 36% of their core Tier 1 capital. Regardless of whether these losses directly affected regulatory capital, because some of the bonds were at amortized cost in the bank's balance sheets, they had an adverse effect on perceptions of solvency in those national banking systems. And the second channel was via negative confidence effects. Because the public sector makes up roughly half the economy in many euro area countries, and because of the credit rating dynamics, the fear of possible sovereign defaults had a dramatic effect on confidence in the domestic private sector. Any distinction between firms and banks, and between banks with and without high sovereign exposures, disappeared. The general loss of confidence in these countries' prospects reverberated through the banking system via further fall in growth. In this way, the crisis spread to banks that did not have significant exposures either to the US prime assets or to domestic real estate, and therefore had not, until then, needed to be bailed out. However, governments in these countries found themselves unable to substantially respond to the emerging crisis with public money for the banking sector and with counter-cyclical fiscal policy due to lack of fiscal space and high debt. Financial markets then began to fragment along national lines, and cross-border funding dried up, exacerbated by the defensive risk management by banks and ring-fencing of liquidity by supervisors in core countries. Lack of liquidity, coupled with capital depletion from domestic losses, precipitated a renewed credit crunch. Countries were trapped in a bad equilibrium caused by the three-way link between sovereigns, banks, and domestic firms and households. Falling credit aggravated the ongoing recession, increased loan losses, and further weakened bank balance sheets, which in turn pushed sovereign borrowing costs higher. Fiscal policy, under the pressure of losing market access altogether, took mainly the more expedient route of higher taxes, which led instead to lower growth, and therefore renewed market jitters, somewhat defeating its own original purpose. The fourth stage of the crisis was triggered by investors in both Europe and the rest of the world. Faced with a downward growth spiral, many investors reached the conclusion that the only way out for crisis-hit countries, given the institutional design of the euro area, was for them to exit from it. This would, it was believed, allow them to depreciate their currencies and regain monetary sovereignty. Fearing redenomination into lower value currencies, investors sold off domestic debt and private debt, further widening the spreads and exacerbating bad equilibria within vulnerable countries. In 2012, spreads vis-à-vis German 10-year government bonds reached 500 basis points in Italy and 600 basis points in Spain, with even wider spreads in Greece, Portugal, and Ireland. The fifth stage of the crisis then followed. the breakdown in monetary policy transmission across the euro area. Interest rates faced by firms and households in vulnerable countries became increasingly divorced from short-term central bank rates. As those economies represented a third of the euro area GDP, this posed a profound threat to price stability. The ECB responded with its announcement of outright monetary transaction, which was recalled by Professor Merriman a few minutes ago, which restored confidence in sovereign bond markets, helped to repair the monetary policy transmission mechanism, and broke the downward spiral. We should also remember another important event of that year, with less of a direct market impact, but fundamental in confirming to the world the strength of our leaders' commitment to the euro, was their earlier decision to create the banking union and the European Stability Mechanism. The long trip back to growth had begun. The unfolding of the euro area crisis yielded lessons for the financial sector, for individual countries, and for the Union as a whole. But the unifying theme was the inability of each of these actors to effectively absorb shocks. In some cases, because of their weaknesses, they even amplified these shocks. Indeed, banks fueled the build-up of imbalances and then exacerbated the resulting crash. Countries had too low growth potential, limited flexibility to bounce back from the crisis, and too little fiscal space to stabilize their economies. And the euro area as a whole was shown to have no public and very little private risk sharing. In the classical optimum currency area literature, what makes membership of a monetary union work for all its members is a trade-off. What they lose in terms of national stabilization tools is counterbalanced by new adjustment mechanisms within the currency area. These mechanisms are typically held to be labor and capital mobility, as well as fiscal transfers between different parts of the Union. In other words, they are ex post and take place after a recession has set in. In the United States, which is a relatively well-functioning monetary union, ex post adjustment plays an important role. Fiscal transfers through the US federal budget are estimated to absorb around 10% of the shocks, while about half of the long-run response to a rise in unemployment takes place through labor mobility. But the outcomes achieved in the United States are not substantially different to those in the euro area. Though the euro area doesn't have a large central budget, national fiscal policies can still provide significant stabilization, so long as countries can use fiscal policy freely. It is estimated that 49% of an unemployment shock is absorbed by the automatic stabilizers in the euro area, whereas the figure for the United States is 32%. And studies have found a gradual convergence in labor mobility between Europe and the United States, reflecting both a fall in interstate migration in the US and a rise in the role of migration in Europe. Where the euro area and US and the United States differ more is in terms of ex ante risk sharing. That is, insuring against shocks through financial markets. This was a concept that only appeared later in the literature on optimal currency areas, but it plays a key role in stabilizing local economies in a monetary union in two ways. The first is by delinking consumption and income at the local level, which happens through integrated capital markets. If labor income falls during a recession, but the private sector holds a diversified portfolio of financial assets, people can smooth their consumption with the financial returns they receive on assets in better performing parts of the Union. The second way is by delinking the capital of local banks from the volume of local credit supply, which happens through retail banking integration. Because local banks are typically heavily exposed to the local economy, a downturn in their home region will lead to large losses and prompt them to cut lending to all sectors. But if there are cross-border banks that operate in all parts of the Union, they can offset any losses made in the recession-hit region with gains in another, and can continue to provide credit to sound borrowers. In the US, both credit and capital market integration have played an increasingly important role in smoothing local shocks over the past decades. For example, following the oil price collapse in the mid-1980s, almost every bank in Texas failed, creating a statewide credit crunch. One reason for this was that out-of-state banks were banned from Texas market. And so the balance sheets of local banks were completely concentrated on their home state. But since then, there has been major integration in the retail banking sector, with a number of multi-state banks increasing from around 100 in the early 90s to more than 700 today. And this has significantly weakened the relationship between local capital and local credit supply. And as a result, the volatility of business cycle shocks among United States states has become smaller. Overall, it is estimated that around 70% of local shocks are smoothed through financial markets in the United States, with capital markets absorbing around 45% and credit markets about 25%. In the euro area, by contrast, the total figure is 25%. Private risk sharing, of course, has its limits. Faced with large common shocks that affect the whole monetary union, the benefits of diversification can break down, as happened to some extent in the US as well during the crisis. One study finds that capital market risk sharing in the United States dropped by almost a half in the crisis period. But this doesn't alter the conclusion that deepening private risk sharing in the euro area would be beneficial for macroeconomic stability. So the question for us is, how do we achieve it? The experience of other monetary unions and our own up to now suggests that it doesn't happen by itself. Rather, private risk sharing has to be enabled by public sector policies at both the national and the union levels. In this sense, private risk sharing cannot be seen as a substitute for further developments in the economic and monetary union. It is rather a complement to it and follows from it. The policies we need fall into two main categories. First of all, we need policies that make the financial system more stable, both by increasing the resilience of banks and by completing the banking union and the capital markets union. The euro area has already made good progress on these fronts. The post-crisis regulatory reforms have significantly strengthened the banking sector. The common equity Tier 1 ratios of significant banks have risen from 8.7% in 2008 to 14.5% today. In the same period, leverage ratios have risen from 3.7 to 5.8. And banks have a much more stable liquidity and funding. The creation of European banking supervision has also brought about a more uniform approach to how banks are supervised. And the new European Union resolution framework has shifted the cost of bank failures away from sovereigns and onto the financial sector, which creates another channel of private risk sharing. Without entering into the discussion of which further regulations may be necessary for the shadow banking sector, we have to acknowledge that the banking union and the capital markets union are not yet complete. We lack a truly level playing field for cross-border banks and investors, and this stands in the way of deep financial integration. A single financial market should have one set of rules, and all market participants should be able to operate freely within it. Yet that's not the case at present. For capital markets, there are differing rules and market practices for financial products across countries, and insolvency and judicial systems vary widely. This matters because a consistent and efficient framework for pursuing failed contracts is vital to reduce uncertainty for cross-border investors. ECB analysis finds that where insolvency and judicial frameworks are more efficient, risk sharing through both capital and credit markets is higher. For banks, the single market is still fragmented along national lines. First, discrepancies in the regulatory framework reduce the economies of scale for banks operating across borders. Second, an incomplete framework for bank resolution also deters cross-border integration. When resolution is not fully credible, it can create incentives for national authorities to limit capital and liquidity flows, as we've seen, as I was saying a moment ago, during the crisis through the ring fencing that some supervisors have practiced, so that they can advantage their depositors in the event of a bank failing. But when the new EU resolution framework is completed and working properly, such concerns about depositors should be allayed. The Bank Recovery and Resolution Directive already places depositors at the top of the creditor hierarchy in resolution. And the new minimum requirements for own funds and eligible liabilities should ensure that there is a sufficient buffer or loss absorption capacity to make depositors bail-in extremely unlikely. What is still missing, however, is a backstop for the Single Resolution Fund. Resolution needs financing. And the Resolution Fund, which is funded, by the way, it's funded by banks, it's not funded by public money, will ensure that it is paid for by the private sector. But in very deep crises, the resources of such funds could be depleted. That is why in all the other large jurisdictions, such as the United States, the United Kingdom, and Japan, resolution funds are always backstopped by the fiscal authority. The aim of such backstops is not to bail banks out. Any funds borrowed are repaid by the private sector over time. Rather, the aim is to create confidence that bank resolution can always be enacted efficiently, which has a stabilizing effect in a crisis and prevents more banks from being dragged into difficulties. In other words, policies, and that's something that we'll see in a moment in other instances, in other words, policies that reduce risks for the banking system as a whole will also lead to larger risk reduction for individual banks. Let me give you an example of this. A very good example of this is the Federal Deposit Insurance Corporation in the United States, which is also the resolution authority and is backstopped by a credit line with the US Treasury. During the crisis, around 500 banks were resolved in the United States without triggering financial instability. In contrast, one estimate puts the total number of banks resolved in the euro area in that period at around 50. An orderly resolution of this magnitude was possible in the United States because of confidence in a well-functioning resolution framework. And the presence of the Treasury backstop was fundamental in creating this confidence. Indeed, the FDIC, the Federal Deposit Insurance, ultimately didn't have to draw on its credit line, but it was clearly reassuring to markets and to depositors that it had that option as a last resort. In fact, the FDIC has borrowed from the Treasury only once, during the savings and loans crisis in the early 90s, and it did repay in full a few years later. This example underlines that the dichotomy between risk reduction and risk sharing that characterizes the debate today is in many ways artificial. With the right policy framework, these two goals are mutually reinforcing. Public risk sharing through backstops helps reduce risks across the system by containing market panics when a crisis hits. And a strong resolution framework ensures that when bank failures do happen, very little public risk sharing is actually needed, as the costs are fully borne by the private sector. So we need to put things first things first, and complete the resolution framework in all its dimensions. And creating a properly designed European deposit insurance scheme would be an additional element that could further reduce the risk of bank runs. All in all, a consistent framework of regulations, laws, judicial enforcement, and resolution is essential for deep and resilient financial integration. Completing the banking union and the capital markets union is therefore a necessary condition for the expansion of private risk sharing in the euro area. Yet, it's not a sufficient condition. And this brings me to the second area where public sector policies can complement private risk sharing by increasing economic convergence and thereby building trust among cross-border investors. The crisis showed clearly the potential of some euro area economies to become trapped in bad equilibria. And plainly, as long as this risk exists, it will act as a deterrent to cross-border integration, especially for retail banks that cannot cut and run as soon as the recession hits. Put simply, we will not be able to foster private risk sharing in our union if crisis can call its very integrity into question. So if we are to deepen private risk sharing, the tail risk of bad equilibria needs to be removed and replaced by policies that lead to sustainable convergence. This requires action at both the national and euro area levels. In the eyes of many observers, three features made countries vulnerable to downward spirals: weak banks, lack of fiscal space, and low growth. Stabilizing the financial sector in the ways I've just described would address one part of the problem. But the common factor uniting all three was growth. Very low growth rates reduced fiscal space and harmed bank balance sheets. At the national level, structural reforms, therefore, remain a priority. We know that structural reforms boost growth. Looking at the last 15 to 20 years, euro area countries with sound economic structures at the outset have shown much higher long-term real growth. And we know that they help countries recover more quickly from shocks, which prevents recessions from leaving lasting scars. That said, while sound domestic policies are key to protect countries from market pressure, the crisis showed that in certain conditions they may not be enough. Markets tend to be procyclical and can penalize sovereigns that are perceived to be vulnerable over and above what may be needed. Over and above what may be needed to restore a sustainable fiscal path. And this overshooting can harm growth and ultimately worsen fiscal sustainability. And this creates a need for some form of common stabilization function to prevent countries from diverging too much during crisis, as has already been acknowledged with the creation of the European facilities to tackle bad equilibria. One of these facilities, of course, is the ECB's OMT, which can be used when there is a threat to euro area price stability and comes with an ESM program. The other one is the ESM itself. But the conditionality attached to its programs in general also implies procyclical fiscal tightening. So we need an additional fiscal instrument to maintain convergence during large shocks without having to overburden monetary policy. Its aim will be to provide an extra layer of stabilization, thereby reinforcing confidence in national policies. It's not conceptually simple to design such an instrument, as it should not, among many other complexities, compensate for weaknesses that can and should be addressed by national policies and national reforms. It's not legally simple, because such instruments should be consistent with the treaty. And as we've seen from our long-standing discussions, it's certainly not politically simple. But regardless of the shape that such instrument can take, from the provision of supranational public goods like security, defense, migration, to a full-fledged fiscal capacity, the argument whereby risk sharing may help to greatly reduce risk, or whereby, in other words, solidarity in some specific circumstances contributes to efficient risk reduction, is compelling in this case as well. And our work on the design and proper time frame of such an instrument should continue. Let me conclude my presentation saying that this year the ECB is celebrating its 20th birthday, And next year, we'll be able to mark the 20 years of the euro. In those 2 decades, the euro has become a feature of our lives and a symbol of our European identity. 3/4 of euro area citizens now support the single currency. And when people are asked to name the most important elements of their European identity, the euro is the second element they cite, after the values of democracy and freedom. The people of Europe have come to know the euro and trust the euro, but they also expect the euro to deliver the stability and the prosperity it promised. So, our duty as policymakers is to return their trust and to address the areas of our union that we all know are incomplete. Thank you.